A real quick one today. Yesterday we talked about time series data and cross-sectional data. Here the idea is, what types of data works best in terms of which factors and its predictability. As a refresher, cross-sectional data, we're looking at, the same metric but across firms, the same metric at the same time across firms here. So here we have, the earnings to price ratio across its current across firms in the same sub-industry. Time series data, again, we're looking at the same metric, we're looking at it, same firm, but we're looking at it over time, how that changes over time. And the question is, which factors, are better able to predict, future returns given what type of data. All right, so it turns out cross-sectional data, when we use those, when we're talking about valuation factors, so earnings to price, sales to price, cash flow to price, of course, the traditional academic book to price, those types of factors work pretty well in the cross section. So we compare, earnings to price across firms today and use that to predict which firms will do better going forward. Now, the information coefficient there, it's somewhere around 0.1, give or take, depending on the market, depending on the factor. But there is some information there. It also works for things like profitability. And in general, if you think about all the academic literature, you think about all these different anomalies that have been well documented, whether ignoring the fact that they may or may not be, repeatable. But all these anomalies, all these academic studies, we're like comparing things against French factor models. And is this truly an anomaly? We're always using cross-sectional data in this case. So just think about, this typical standard way to do this is to use cross-sectional data. So, data now today, and how are differences between firms or whatever it might be, how are they able to help us predict the future? Okay, but there are some applications for using time series data. Now, momentum, interestingly, even though that is often used cross-sectionally, there is some research out there that suggests that momentum is even more effective when you're using it in a time series data format. Okay, so this would be true for, for just simple prices, or it could be true for things like earnings momentum. So, how is earnings changing, but how is that growth rate changing, right? So that type of momentum makes sense. There's also factors like seasonality. It seems totally crazy, but if you look, you'll see that companies like, now InBev, but Anheuser-Busch, that their stocks do the best in July. Okay, it makes no sense, but you think about the 4th of July and people drinking a lot of beer with their hamburgers and hot dogs. You would think that would be built into the market, but you'll see things like that, seasonal patterns where, time after time, companies like Anheuser-Busch, InBev do better when the products are more in demand, even though that should be built into the market. These time series data also works, in terms of market timing. So, which is the stock market going to do better or bonds going to do better? So you think about economic variables, inflation and these things like that. So comparing, where things are today, what's the unemployment rate, what's the inflation rate, what's the growth rate, these things, comparing that today versus other time periods helps us, determine, which types of markets, which asset classes may be better or worse. And then there are some factors that do pretty well with both types of data. So carry, that's when we're looking at the difference between the spot price and the futures price, and using that difference, the directional difference, to make trades. Turns out that using both time series data and cross-sectional data is useful when you're talking about carry trades. All right, so that's about it for today. Tomorrow, I want to get a little more in depth about why these differences kind of make sense. Why we would expect, in certain instances that cross-sectional data works well, and in other instances, time series data works well. That will be tomorrow. Thank you so much for listening.